Lending Club or Prosper, and they are done through a registered S1 registration statement filed with the SEC. So remember at the beginning when I said you have two types of transactions, a registered transaction and a private placement. The registered transaction includes stocks that are issued and traded on the exchange, IPOs. Lending Club and Prosper notes are actually registered transactions. They file an S1 registration statement, they file a 10K and a 10Q, they have a proxy, they have a 424B, which is a prospectus that gets updated 4 or 5 times a day through an automated process, and every loan that goes to the fractional marketplace gets posted on the SEC website. So let me just answer your question. So Title II is the accredited investor world. Now you can run a consumer platform and not have public distribution and only offer to accredited investors, and then you're using Title II crowdfunding. So the same mechanic, it depends on who's your borrower, who are you selling to, and with what. And if you're selling a whole loan, generally it's not deemed a security if somebody's buying the entire loan, and it's an institution or a bank, and then you have a whole loan purchase agreement. Prosper and Lending Club, by the way, are also not banks. There's a whole issue about that. They are using a bank called WebBank, which actually makes the loan and makes the credit decision, notwithstanding that the borrowing criteria are all effectively underwritten by the websites. The banks have to have the effective final say on these loans. Now, the other mechanic going on that's heavily used in the broker-dealer world, and I think I will get to it, is that when you issue securities with some exceptions and you are the issuer, there is a no action letter last year, Angel List and Funders Club, and it's not a new ruling, but the issuer's exemption applies to broker-dealers. And so if you're not selling securities for compensation on behalf of another, if you're actually selling Angel List securities to Angel List investors, then the SEC has said that you do not need a broker-dealer for that transaction. Now what happens? You have a two-step mechanic. The investors go to the site, they like the investment, they like the Realty Mogul investment, or they like the Angel List investment. They're investing in Realty Mogul 19 LLC. Realty Mogul is the actual investor in the project, and they're the company that actually goes on the title if there's a lien filed with respect to the property. The check is written by the Angel List entity, not by the investors. The investors are actually not known to the underlying company. All they know is that they have a full or a partial round that's funded by Angel List. So issuers not eligible to use Title III, public companies, non-US companies, any type of fund or one-off that's not an operating company. I think Congress just did that as a way of preventing others from getting involved. And then I'll go fairly quickly, but this is generally a breakdown of Reg A versus crowdfunding versus private placements. And what you see sometimes when you look at a boxing match, they have like a tail of the tape where they're comparing two Super Bowl teams and which one has the advantage. They put a check mark. So I've gone through here and I've actually put a check mark under each criteria that shows if you were doing this and you wanted the least costly and least restrictive means of going about it, here's what you would do. And for example, maximum total rate. So public crowdfunding, $1 million for every 12 months. Reg A plus, $5 million. Reg A plus tier 2. So there's 2 tiers of Reg A plus. Reg A plus, by the way, the small offering exemption. I think they said that 17 Reg A deals were done last year. It's a very lightly used exemption. You don't have to file a registration statement with the SEC, and your securities are not restricted. The problem with Reg A all these years is that you had to go state to state. You didn't have federal law preemption. Reg A plus tier 2 says you do have preemption. You can go to an unlimited number of investors as long as you are going only to accredit, and you can raise up to $50 million. What we're going to talk about is if someone who can raise $50 million is taking a liquidity discount in a Reg A plus transaction by not listing in a public market. So this essentially goes through my expectation of crowdfunding. I think we'll see rules sometime this year. I think that Jobs Act 2.0 may complicate that. I don't think it's going to go anywhere because from what I hear from people in the Senate, there's absolutely no appetite to take this up with Iraq and with everything else going on, plus the elections. So the 2.0 may actually be holding up the rules because the SEC doesn't want to put out rules that are going to be overruled a week later by Congress. However, it is what it is. I think the principles of it are solid. I think Reg A Plus is going to happen before Title III, and that may happen as early as this summer. There's a lot of interest in the Reg A Plus market, and I'm not sure that people fully understand that it is a little bit more of an intensive exercise than public crowdfunding. You do have to file a document with the SEC, get comments, respond. It's not a self-service offering by any means. Yes?
So under Title II, you do the same thing that the peer-to-peer companies do, i.e. issue borrower-dependent notes, which are an obligation of the company secured by the underlying mortgage on the property.
Well, everything you said except the last part. So, yes, you can issue borrower-payment-dependent notes. No, you do not need to be a broker-dealer, although there is concern in the broker-dealer world that confidence in that may be eroding, and that's why you're seeing a lot of these platforms affiliate with broker-dealers. The notes are not secured. The loan to the borrower is secured. You have a derivative interest in the payment stream from the borrower, but you yourself are not on the title. You do not have a security interest. All you have is a as, when, and if paid interest in the money that comes from the borrower that flows through to the notes. And another secret of this industry is that in peer-to-peer, the consumer platforms don't take a spread, but many of the real estate platforms do. And so what that means is that Lending Club and Prosper say, we're going to take a 1% spread, it's a servicing fee, we're going to charge an origination fee up front, that's our compensation, that's it. Borrower is paying 12%, you're going to receive 11%. Real estate world, the borrower may be paying amounts significantly higher than what the borrower payment note face amount is. So you could have somebody who is a borrower taking a 12% loan, and then the investors in that loan are only getting 8 or 9. And that's where I think a lot of people are seeing significant opportunity in this space. There's no legal or moral rule against doing that, and for many people, it's still a great alternative to the risk-free rate of return. Will that change when the Fed hikes up rates? We suspect it will, but who knows when and how that will be. And I want to turn over some of the time to the other presenters, but obviously we're going to have a Q&A.
Right.
So I know Ryan was slated to speak today. I apologize for any disappointment. My name is Aaron Kellner. I am an investment executive at Seed Invest, an equity crowdfunding platform based here in New York. I head up our investor-facing activities and will do my best to fill in for Ryan. Just to provide some context for my presentation, just going to provide a bit of a background on Seed Invest for those of you who may not be familiar with us, as well as our approach to and outlook of, or outlook on, the equity crowdfunding space. As a platform, we'll probably provide a little bit of a unique perspective from the purely legal aspects of this. One thing to note before jumping in is that equity crowdfunding really is in its nascency. We like to think of it as being in the first out of the first inning, and so the majority of experience in this space so far has really been on the lower end of the spectrum in terms of seed, bridge, and Series A rounds. Where applicable, I will provide kind of extrapolations into where the experiences thus far could be applied to more middle market opportunities. So Seed Invest traced our roots basically to the ground floor of the Jobs Act implementation. Our company's advisors, Woody Neese and Jason Best, are the two gentlemen credited with developing the framework for equity crowdfunding in the US. We helped found two of the leading industry organizations pertaining to equity crowdfunding, and since that time have served as go-to information resources for all things pertaining to the Jobs Act, most specifically in regards to the SEC's proposed rules for Title III. So where are we today? We are an accredited investor funding platform. Our goal is to make investing in startups as easy as buying a share of common stock, and obviously in an SEC compliant fashion. To that end, we have built a technology platform that quite literally allows investors to go from inputting their login information to having a funded and executed investment in a startup in less than 5 minutes without ever leaving our platform. Originally launched in February of last year, we've built our investor network to over 3,500 individuals who are looking to invest in aggregate $175 million in startup opportunities. Also during that time frame, we have helped about 20 companies raise money, and in just March and April of this past year, funded $6 million worth of investments through our platform. We differentiate ourselves along a few dimensions, which primarily derive from the professional background of our founders and our team in general, that being of professional investors. From the get-go, we have maintained a focus on quality over quantity. We are not an angel list. We are not a listing platform. It is not our goal to put as many investment opportunities in front of our investors. It's not why they signed up for us. We are also completely free for investors. There are no transaction fees, management fees. We do not charge carry. We also take a much more inclusive approach to the crowdfunding space. A question that I get asked pretty frequently is, how do you see yourself as competing against angel groups and venture capital firms? Because equity crowdfunding is generally portrayed as being cannibalistic to those types of entities. The reality is that those are exactly the types of entities that we like to work alongside. A not atypical deal on Seed Invest, and just using numbers for simplicity, would be a company that is looking to raise $1 million. The round is being priced and led by a venture capital firm that's writing a $500,000 check. There might be another $300,000 worth of angel investor interest, but you have that 20% on top that they're having trouble filling. Where we add value is by basically allowing the company to syndicate out that $200,000 and make it available to our network of investors. For the company standpoint, they get to offload a significant amount of the fundraising time and energy to us and allow them to focus on their business. From the perspective of the investors that are already committed in the round, they get a more focused management team as well as a better capitalized company. And for investors on our platform, they have access to deals that they might not normally have access to, and get to invest alongside the original investors on the same terms as those investors and don't have to pay anything to do it. The inclusive nature also kind of entails a product that we call Seed Invest Halo, which is actually a cutting-edge white label version of our platform used by angel groups, venture capital firms, et cetera, that I will speak to in a few minutes. So these are just a few of the representative deals on our platform that have been funded. Since we've launched, we are looking at an average raise of about $500,000, about a $30,000 average check size. The largest check on the platform to date has been a $550,000 investment in Fango by a family office that was introduced to the deal through our network. To kind of point to a couple of these deals in specific, Scoop Networks, second from the left on the bottom, is a shared electric motor scooter company based out of San Francisco. Best way to think about them is a mix between Zipcar and City Bike. Provides an excellent example of the power of general solicitation. This company approached their customers via tweets, emails. They had their previous investors blogging about their raise, and were able to convert some of their customers into investors in their round. Virtuix, the Virtuix Omni, third from the left on top, is a great example of how companies can kind of move up the crowdfunding food chain, if you will. Virtuix completed one of the top 10 most successful Kickstarter campaigns of all time, and utilized our platform to facilitate their true seed round. We were able to raise $1.6 million for them in a bit less than 2 months, help them actually bump their round from a $2 million to a $3 million round size. This deal was performed in conjunction with the Houston Angel Network, and through our network, we were able to actually bring in 2 pretty prominent VCs into their round. So as I'm sure you've been made very well aware over the course of today, crowdfunding is growing quite rapidly, and there are very few signs of it slowing down. Like I mentioned at the beginning, crowdfunding is still in its nascency, but there are still leading indicators that we can look to.
You didn't say how you earn revenue.
Yeah, how do you make money?
So we
Little
can,
small thing for them.
there are basically two approaches to the equity crowdfunding kind of game in terms of the business model. There's the model that's utilized by AngelList, Funders Club, WeFunder, and a handful of others, which is essentially kind of more the online venture capital carried interest model. We engage in the broker-dealer placement agent model. So we currently are affiliated with a broker-dealer. Probably about 3 or 4 months from now, we will be our own broker-dealer. And the reason for this business model is a few-fold. One, just from just a company working capital cash flow perspective, we are allowed to take cash fees today instead of having to discount future cash flows from potential liquidation events that may never occur. When it comes to the post-Title III world, crowdfunding platforms will not be able to take carry. So if you have built a platform that has a revenue model derived off of that structure, you are either going to have to undergo a pretty sharp pivot, or you're just going to have to abstain. In either case, you're going to be playing catch up. The last kind of part of it is that, and again, it kind of speaks to the investor-centric nature of our platform, is that while a lot of platforms came out in the wake of the Jobs Act being signed with the mentality that they were going to turn angel and VC investing on its head, that everything was going to be going through these platforms, it's the dawn of a new age. Our belief is that maybe over the long term that's true, but it really discounts the fact that there are literally thousands of individuals, entities, and organizations that have been engaged in this type of investing in essentially the same way since the Great Depression. One of the things that has been a trademark of the way that people have invested in this industry is relationships. Relationships are very important. I myself am not only an investment executive of SeedVest, I'm also a licensed registered representative of our broker-dealer affiliate. What that allows me to do is act as a placement agent for companies on our platform, get on the phone with our investors, let them know about the deals, what we like about them, what we don't like about them, and essentially facilitate their personal due diligence process. So that's the business model, and basically as a broker-dealer, we take a placement fee on the amount of capital that we successfully raise for our companies. That fee is assessed to